Avoiding retirement mistakes, what every government worker should know. Hello, everyone. Thank you so much for joining me today. I'm Alan Porter, owner and CEO of Strategic Wealth Strategies, a certified financial fiduciary, certified tax and business advisor, and a tax strategist. You know, I never thought that I would be a financial advisor. I retired from the Army in 1993. I served for 21 years and completed my career as a Black Hawk instructor pilot for the 18th Airborne Corps. I love flying and serving my country and had a passion for being an expert in my field. I had a successful real estate and mortgage business after retirement up until 2008, when some tragic things happened to my family. My son became 100% disabled with a disease there's no cure for, and his wife died of pancreatic cancer at age 39, leaving two little girls who were 7 and 4. Not long after that, my daughter had given birth to my third grandson and was diagnosed with breast cancer, and we didn't think she was going to live. Thank God she's 12 years cancer-free, but her problems did not end. She was diagnosed with Graves' disease and thyroid eye condition, and after much testing at Duke and the Mayo Clinic in Rochester, there is no cure for her. Because of this, I am very passionate about educating people on financial strategies that I have learned in the past 15 years that many financial planners, CPAs, and attorneys know very little about or nothing at all. I've spent years helping government employees like you navigate the complex world of retirement with one primary goal in mind: keeping more of your money in your pocket, legally and tax efficiently. If you work in federal, state, or municipal government, you're in a unique position. You've likely built up a pension, contributed to the TSP, a Thrift Savings Plan, or a similar plan, and earned benefits that can provide lifetime income. But here's the truth. Most people don't realize how you use those benefits and can either make or break your retirement. Today, I'm going to give you clarity on the retirement tools you already have and introduce you to strategies that can turn them into a powerful, tax-advantaged retirement plan. Let's start with the three major building blocks for most government retirees. Number one, your pension, FERS or state local pension. Number two, Thrift Savings Plan, TSP. Number three, Social Security number one. Your pension. The pension is your guaranteed income. But there are choices. Survivor benefits. Should you leave a portion to your spouse? It reduces your monthly income. Cost of living adjustments, COLA. Some plans include them, others don't. That affects how inflation impacts your future income. Taxes. Pension income is fully taxable as ordinary income in most cases. Number two, your TSP. This is your retirement investment account. But be cautious. Most people leave it in the traditional TSP and take withdrawals. But that means 100% of every dollar is taxed. That means several different types of taxes. And what do you think taxes are going to do in the future with a $36 trillion deficit now and unfunded liabilities of over $103 trillion and increasing every day? You may have options to roll it over into a more flexible IRA, or better yet, use a Roth conversion strategy if done carefully. This investment, if in a stock portfolio, compounds all of the risk in retirement and is not guaranteed. You pay a fee to the advisor whether you make money or not. Does that seem fair? Number three, Social Security. Timing is critical. Should you take it at 62, full retirement age, or delay to 70? The vast majority of people take Social Security to their detriment. 53% of people that take Social Security use it as their number one asset in retirement. Delaying increases your monthly benefit, but it also creates a taxation cliff when combined with your pension and TSP withdrawals. Creating a tax-free retirement plan. Here's what a well-designed tax-free retirement strategy looks like. Use Roth accounts wisely. Oh, you may have a Roth TSP. Keep contributing if you're still working. If retired, consider converting portions of your traditional TSP to a Roth IRA during lower income years. These grow tax-free and can be accessed without RMDs. Again, this account can eliminate some of the risk in retirement, but many of the other risks in retirement remain, which I will explain shortly. Again, if this is in a stock account, you pay that advisor a fee, whether you make money or not. Here is another very important subject you need to consider also. Many people, after retiring from the government, will start a new career and start to fund another retirement plan, such as a 401k. We have been inundated by the propaganda of Wall Street and fee-based advisors to invest in the market in a 401k for your retirement. And in my opinion, and the opinion of properly educated advisors, that is a mistake. It is outdated advice. Even the person that invented the 401k, Tom Bena, says it's a monster and needs to be destroyed. I have him on video. Remember that fee-based advisor is always making money, whether you make money or not. I ask people why to contribute to a 401k, and they all say the same thing. It's a tax deduction. I just let them know that is not a tax deduction, but a tax compounder. What do you think taxes will do in the future with our national debt over $36 trillion and growing, and our unfunded liabilities in the hundreds of trillions of dollars? Very few people know about the fees in their 401k. In fact, 58% the people don't even think there's a fee, and up until 3 years ago, it did not have to be disclosed. Do you realize that a 1% fee over a 30-year period will reduce your income by 1 to 3, and the average fee of a 401k, and this is according to Forbes magazine and Lap Times, is 2.99%. People will have less than half of their money in retirement and then get hit with taxes from 20 to over 55%. And they all tell me the same thing. Why didn't my advisor tell me this? I have a much better option, and I have been doing it for over 15 years, and I have never suffered a market loss. Incorporate Indexed Universal Life Insurance, IUL, which I feel is the best tax code approved tax-free retirement system available today, with many benefits, and eliminates or mitigates the risk in retirement that a stock portfolio only compounds. These risks include, but are not limited to, the following risks: sequence of returns risk, which will decimate your retirement, and very few people know about it. Basically, what this is an example. If you have a loss in the market in the first 2 to 3 years when you go to retire in a 10 or 20 year period, as compared to the last 2 to 3 years of a 10 or 20 year period, you will be out of money between the 6th to 9th year. The reason being is you are taking money out of a decreasing asset and not putting money back in. The number one fear in retirement is running out of money before you run out of life. It does not affect the taxation of Social Security or the means testing for Medicare Part B, which will be in the thousands of dollars per year. You are protected from lawsuits, liens, and judgments, and avoids probate. You can eliminate or mitigate the cost of long-term care, which right now is between $50,000 to $200,000 a year, and goes up every year with tax-free money for pennies on the dollar. You can become your own bank, borrowing from yourself and paying yourself back compounding interest for you, and not the financial institutions, and eliminating the effective interest cost that you pay on the money that you borrow. And people have no idea about this. I have been doing this for 15 years. It eliminates longevity risk, which is a risk multiplier. It also eliminates tax risks, government risk, and interest rate risk. I know all of this for a fact, as I have 8 life insurance policies, 5 index universal life policies for myself and my wife for our tax-free retirement, and will also leave a legacy for our family when we pass away, and 3 whole life policies, one which I use to show my clients my debt-free for live program, and the other 2 or for college funding for my granddaughter's colleges. There's not a better financial vehicle to fund college than cash value life insurance when properly constructed. It gives you the ability to take advantage of a down market and gives you leverage to make money through arbitrage the same way the banks do. Please understand that banks have cash value life insurance as one of the top tier 1 assets, if not the top. It is almost twice as much as real estate and many times more than stocks. You can go to FDIC.gov to confirm, as it shows the asset sheet of every major bank in the United States. Insurance companies are the strongest financial institution in the United States, have been in existence for hundreds of years, and the only financial institution that paid dividends during the Great Depression. Their products are in an asset class all their own, as no other financial vehicle can compare to the benefits and protection they can provide to you and your family. Properly structured IULs allow for tax-free withdrawals through IRS codes 7702 and 70E via policy loans. No RMDs, required minimum distributions, no taxes, no income reporting to the IRS, can double as long-term care coverage if designed correctly. Tax-free too, coordinate income streams. This is very important. Use pensions as a baseline to pay for the basics in life, housing, food, mortgage. There are other forms of guaranteed income besides your Social Security with properly constructed fixed and fixed indexed annuities that can give you the same amount of money for a portion of your TSP or stock portfolio. As an example, if you have $1 million in a stock portfolio or TSP, they have assumed for years that a 4% distribution rate, which would be $40,000, would last for 30 years, adjusted for 3% inflation. The problem with that is that it is not guaranteed. Do you realize you would only have to have approximately $650,000 improperly constructed fixed indexed annuities to give you the same $40,000 per year, which is guaranteed and increasing income, when the indexing strategies we use to grow the value increase? Even if the accumulation value runs out, the insurance companies still have to pay you to age 120, which all of my plans do. That leaves you approximately $350,000 to turn that into a Roth, and probably extra money to do with what you want. And the vast majority of people have no idea about this because of their fee-based advisors. Use Roth financial vehicles and cash value life insurance, such as the Index Universal Life Policy for gap years, especially before Social Security kicks in. Delay Social Security for larger, inflation-adjusted payouts, as Social Security increases 8% every year with a cost of living increase also. 3. Avoiding IRMA penalties, AISO. If your income is too high, Medicare premiums rise sharply. Tax-free income from Roth or cash value. Life insurance policies, whether they are whole life or an index, universal life also will not against these limits. Let's talk about the top 5 mistakes government employees make when retiring. 1. Relying only on TSP withdrawals without knowing the tax consequences. You have to plan for this, and if you don't, you're going to lose thousands of dollars to taxes. 2. Not planning for RMDs. As I said, you must plan. If you don't have a plan, make one. If you do have a plan, you need to review it every year, and if you don't, this can create massive tax spikes at age 73. 3. Taking Social Security too early without evaluating income needs and taxation. As I said before, the vast majority of people take Social Security to their detriment and not to their benefit. 4. Ignoring inflation and healthcare costs, especially long-term care. This is extremely important, especially healthcare costs. Right now, it is estimated that a married couple age 65 will spend approximately $340,000 in their retirement for healthcare costs, and it's going up every year. And if you have critical care involved, that's closer to $400,000. Now let's talk about long-term care. Many people tell me, well, I don't have to worry about long-term care. I'm very healthy. I've got news for them. 70% of all Americans will need long-term care at some point in their life. 40% of all Americans on long-term care right now are between the ages of 18 and 64. And this is an age lab study by Dr. Pokorski at MIT University that states if you are married and age 65, there is a 75% chance of you or your spouse contacting Alzheimer's, dementia, or Parkinson's. I know this for a fact, as my brother has Alzheimer's, and he is only 3 years older than me. 5. Failing to create tax diversification, having everything in taxable or tax-deferred accounts that have tax-efficient saving strategies. I have a tax strategy that is going to get back 4 years of back taxes of over $2 million. I am also taking his qualified plan of over $1,400,000 and turning that all into tax-free money. People always ask me, Alan, how do you do that? I let them know it's not how I do it, but who I know that knows how to do it. And these are the people on my team that of the specialists in their fields. And what I mean by a specialist, let me say, I'm your primary healthcare doctor. I can treat you for minor illnesses and minor injuries. But if you want your knee operated on, you want an orthopedic surgeon to do that because he's the specialist. And that's what I have on my team. Your CPA, financial advisor, and attorney, or more like your medical doctor. They are not specialists. Each of these mistakes can cost tens of thousands, but they are all avoidable with proactive planning. You've served your community, your state, or your country. Now it's time to ensure your retirement serves you with financial security, peace of mind, and the ability to live the life you've worked so hard to build. If you want to find out how these strategies could work for your situation, I invite you to schedule a free one-on-one tax-free retirement review with me. We'll analyze your pension, TSP, Social Security, stock portfolio, all qualified plans, and tax exposure. And I'll show you options to increase your income while reducing your tax burden. I've had many affluent clients tell me that their CPA, financial planner, or attorney handle all their tax and financial decisions. I let them know that is fine. I'm not here to replace any of your advisors, but to work with them as a team to give you, the client, the best possible financial future. But I asked them two questions. When is the last time any of your advisors ever give you any proactive advice on saving taxes? I find it slim to never. They always give you reactive advice. This will cost you hundreds of thousands, if not millions of dollars. The other question I present to them is, you may have the greatest advisors in the world, but it is what they don't know that's going to end up costing you hundreds of thousands, if not millions of dollars, and undue taxes, fees, and lost opportunity cost. They all agree, but then they asked me all, what do you mean by lost opportunity cost? And I let them know, what if I can build a tax-free retirement through a tax strategy that we have implemented that is paid for by the government that is tax-free? Wouldn't you want to know about that? If any of this interests you, please call me at 910-551-1046. I do not charge for my consultations. I want to educate people on the financial strategies the wealthy and the banking institutions have been using for years. I want to create a paradigm shift, and you're thinking to think outside the box of conventional financial planning. This is all education that should be taught in high school, but it's not. I even have doctors as clients with PhD degrees in accounting and finance and have no idea what I talk about and have been asked to teach their students. As I stated before, I'm a certified financial fiduciary, certified tax and business advisor, and a tax strategist. I do not give tax advice that is up to your CPA and attorney. But my team and I know of tax strategies that your advisors may know a little bit about or nothing at all. I have also been published in over 1,587 publications across America. I was selected for Who's Who in America in 2023 for excellence in financial advice, selected as one of the top 100 financial advisors this year. I have spoken at West Point, where I was selected as outstanding speaker at the leadership conference there, and also spoke at Harvard outlining these strategies. I have been seen in and interviewed on ESPN, ABC, CBS, CW, Fox, and CNTV, which is Consumer News Network, which I was their wealth advisor. I have a national podcast and have co-authored or authored 9 books. My latest book, which I authored, is an Amazon bestseller. The title is Tax-Free Retirement Solutions. More information can be found at my website, which is strategicwealthwealth.com, where I have hundreds of videos, newsletters, and articles, and you can book an appointment with me. No obligation, just education and clarity. My email is strategicwealth0@gmail.com. I hope you enjoyed this webinar, as I have, and the financial education that I hope you have derived from this. Please give me a call. Let's start a plan to save you more money in taxes and secure a financial future for you and your family. Thanks again for attending. Again, Thank you for joining me today. And remember, it's not how much you make in retirement, it's how much you keep.